All right, everyone. Charlie and I are back to give you the latest on what's trending in CTA, which is the Simplify Managed Future Strategy ETF. We're going to talk to you guys about the month of January, and a lot went on. I think metals are front and center, but we also had some really cold weather, so we'll talk about nat gas as well. So let me share my screen and we can dive right in. Charlie, let me know when my screen is visible on your side.
I can see it. Here we
Cool,
go.
let's go. Or as dads would say, let's rock and roll.
Nice.
So this is through the end of January 2026. It has been a chaotic start to the year, especially in the commodities space. You'll see CTA performance through the end of the month. We're running at about 8.9% annualized return. Despite some of the rockiness, CTA actually delivered an attractive positive return. Trend following broadly outperformed equities and bonds. And we'll talk about some of the specific drivers for our strategy in particular. But of course, the key benefit of having this alongside a 60/40 portfolio or whatever risk balance you have, traditional stocks and bonds, is that it provides very attractive levels of diversification. So still running that negative zero point 0.2 correlation to the S&P 500 since inception, as well as a negative zero point 0.34 correlation to the aggregate bond index. Common question I am asked is, given the inclusion of commodities in CTA, can I hold this alongside a static commodity allocation? And you'll see here, just based on the correlation profile, because we're unconstrained and have that long short capability in CTA, we've actually had about a zero point 0.1 correlation to the Bloomberg Commodity Index since inception. So very attractive returns and correlation profile. Given all that went on this month, I want to spend most of our time having Charlie share his insights. But just as a reminder, in November of 2025, we expanded the list of markets that CTA can trade in for both diversification and alpha potential. You'll see here on the far left interest rates across developed markets in US, Canada, and Europe and UK. And then you'll see across the basic commodity sectors, energy, ag, metals, and livestock in both US, Canada, and European markets. So a expanding list of markets still within those core asset classes, which is interest rates and commodities. One thing I do want to highlight again is that really attractive return and profile relative to traditional stocks and bonds. So the white line that you see here is the Simplify Managed Future Strategy ETF plotted against the typical US-centric 60/40 portfolio, which is the orange reddish line. And again, that really nice zigzag pattern is what we're looking for, especially as you think about adding an attractive diversifier in your portfolio. Let's talk about some of the recent performance. This is through again the end of January. We still have the 4-star Morningstar rating, and you'll see on a trailing 3-year period, we're in the 13th percentile, and so really long, attractive long-term returns. The last year has been bumpy. I would encourage all of you that are maybe new investors or looking at CTA as an investment to go back and watch Charlie and I's prior videos. They're all on our YouTube. We do this on a monthly basis, and we'll talk about some of those drivers as to what's kind of rocked the boat, really kicking off with the tariff tantrum in 2025, but still kind of charging ahead, leading the category from a longer term return perspective. And then the quarter to date that you see here is really just the trailing 1 month period because we're in a new calendar year. And we'll talk about, of course, that kind of sell off towards the end. I'm a big fan of The Price is Right. And I think about the Yodeler game where the Yodeler goes up. And that was really the metals space in much of January. And then we kind of rolled over in that last day of the month. So would love, Charlie, for us to kind of dig into that. As background, Charlie has extensive experience trading in metals, and so he can give some of his insights on what he thinks has really been the driver behind this and where we're headed. Of course, doesn't have a crystal ball, but some interesting things going on out in the marketplace. And so, just to kind of kick us off, you'll see on the top left, month to date and quarter to date performance, of course, are the same because we only have 1 month under our belt. But the return of CTA in the month of January was 2.72%. And again, we'll talk about some of the maybe underperformance relative to the industry benchmark, but from an absolute or total return perspective, attractive again relative to a 60/40. So I will pause. And Charlie, where do we want to start? What's top of mind for you?
Well, the main event in January was the metal market, and in particular, precious. And I think there's a couple of different things going on. So you have sort of your standard narratives around possible debasement of the dollar, debasement of fiat, global government. Um, the global developed world government complex feels like its fiscal deficit is offsides, and people are kind of looking to hard assets as a store of value. But that has clearly now transmuted, if you'll pardon the pun, in Precious, into a momentum feedback loop and an untold amount of leverage buildup, which then became spectacularly unglued toward the end of January and into the first days of February, which is super, super, super wild.
Just a
And
quick reaction from me as well, which I think was crazy to see, is despite the fact that we had this historic sell-off in metals, there were still positive returns for the month. Like that's how far the run-up was, is that we could sell off that much and still outperform stocks and bonds.
yeah, I mean, whenever you have one of these super trending kind of exponential curve of price, you're also getting high volatility. And because our systems are looking at not just the expected return, but also the expected risk, um, we want to be smaller. The system wants to be smaller just because the
That's
volatility is
actually
high, even though it's
that's a
going
gr-
up. Right?
that's
Yeah.
a great point. We actually had someone reach out as silver was moving parabolic and wondering why our gold position was larger than our silver position. So that exactly speaks to it, is within the model system,
Yeah.
we are looking at volatility.
Yeah. And so I think there's been quite a bit of chatter in the market going like, how could this happen? What's going on? And I think it's a story. And the story is basically like for the last couple of years, precious metals seem to have outperformed and they've kind of traded in line with their usual relationships with the dollar, with interest rates and this kind of thing. And yet somehow they're going up more than usual. So it's like you're behaving in terms of your motion relative to everything the same, but drifting higher. And that sort of suggests that somebody's been buying that doesn't really care about what's going on in the rest of the market. And the only people who can do that typically are people who have permanent capital, and nobody has more permanent capital than a central bank. So the theory has been that since the U.S. Put sanctions on the Russian assets and sort of took over control of the Russian assets on deposit in the U.S., the central bank of Russia and presumably the central bank of China have been buying gold on the sly. Now, I can't prove that. It's all cloak and dagger, but you can kind of see this new drift in the tape over the last couple of years, and that's interesting. Now, the challenge with that is that people notice, and when people notice, they also start to put the trade on, typically with leverage, and then more leverage, and then more leverage. And when you have these assets that are real markets of real molecules in the real world, it's sort of a thin funnel just to be able to absorb inflows of paper dollars, right, at scale. So when you get into that inelastic kind of vertical part of the supply curve, where small changes in additional quantity mean big changes in price, kind of anything can happen because it's basically like the supply curve is vertical, and then any change in demand is moving the price a lot. And that's been happening with leverage and also possibly the market structure changing. So there have been huge increases, for example, in onshore investor products in China. For example, ETF balances. ETFs were not really a big thing in China until kind of recently, but the Chinese gold ETFs are, they've done a massive increase in assets. And so people buying on leverage is building up leverage, and then the position gets crowded. So even if you have this pervasive uptrend of official sector demand, the Me Too, is creating cycles of up and down volatility on top of that basic drift. And so you had like, basically a feedback loop of leverage unwinds over the last couple of days in Precious, and it was sort of epic in its scale. It felt more like kind of a crypto trading type situation where the order book is getting swept and stop losses are catalyzing more stop losses. Super interesting. But from the perspective of a product like CTA, um, you're looking at volatility, and again, as the noise in the market is going up, your signal to noise ratio is going down, and hence some de-risking there. But it was still a pretty good investable trend despite the collapse. We would have de-risked a bit before that, just on the increase in volatility.
And maybe
Um,
one thing I'll mention here as well, because I know as it relates to many allocators' portfolios, typically there's a single holding to gold, because gold has always been viewed as this safe haven asset, not low volatility by any means, but constrained or contained within its volatility profile. And I think the whipsaw that we've seen in metals in the last few weeks here is a really good reminder of the importance of diversification. And so having clients think about ways to gain access to the parts of the market within commodities, if it is gold, if it is silver, just metals broadly, having a strategy that allows you to get in and out in a more flexible or dynamic way and scale those positions accordingly. Because if you're just holding a single asset, single security, of course, you're going to be more exposed. And so, again, despite the sell-off that we saw, you'll see here on the contributors columns, gold and silver were still the largest positive contributors. So I think
Yep.
that's
And that's
important.
because, again, we're diversified. And as the volatility of that whole kind of basket was going up, we were cutting well before. And that's the problem with trend following in general is like, it's hard because if you just do a pure trend, you're just going to be like the last person at the party, right? And it always feels sad to leave the party early because people are having a good time. But nothing is perfect, and we do the best we can statistically.
I
And
usually leave the party the
yeah,
earliest. I do the Irish exit, so
nice,
this
smart,
that resonates with me.
very wise, planning for the day ahead. And
Yeah.
like I said, we got smaller as the volatility picked up because the party was getting a little too crazy. So there was that. In other assets in the month, a pretty wild ride in soybean oil, where short trend signals and some short breakout signals were met with a policy-driven reversal, and gave back a little bit of performance there. And then maybe more interestingly, in natural gas, we actually had kind of an okay or flat-ish return in energy, but it didn't feel like it because we made money through most of the month as crude rallied a little bit and nat gas was selling off, and then it was just crazy cold. It was so cold in America, and nat gas in the front end got a little bit tight for a few days, and the curve, as nat gas does, goes, and our front end shorts, where typically we're earning a lot of roll down for those storage costs, um, got punished a little bit episodically on the weather, and that happens. We to put into context, the front end had roughly a doubling in price, and we gave back, I don't know, a point or something. So the key with these things is you try to earn the risk premium on the carry, and every now and again you get bit, and the game is sensible risk management and correct sizing. Not trying to pull more out of it than is there from a risk management perspective. And so that's sort of what we did.
One
And the
other
system.
question, Charlie, on the oil and gas. I
Yeah,
think January was one of the strongest months from like a price appreciation perspective in that space since 2022,
yeah,
maybe. And I know
yeah,
that's a theme you've talked about in the prior months videos that we record and just in our discussions is within the commodity space broadly, oil and gas have been kind of quietly sitting in the backdrop. They've been more
yeah.
deflationary. Do you think this is the start of something, or is this more of just a blip given some of
That
the
is such a good question.
global
I would say,
tensions?
yeah, I would say like we're not. If I were discretion, I don't really take discretionary views in this. Like my team and we work and research and we build the best statistical systems we can. But if I had my druthers as a discretionary trader, I would definitely be bigger in energy than we are, especially in oil, because I do think we are perhaps underestimating the amount of hoarding demand required in this increased geopolitical risk environment. Number one, which means all this oil that's on water that people are kind of worried about creating the supply glut. It's like everybody has an incentive to build storage and store it now, especially the Chinese. And so I'm not as convinced that there is as big a glut as sort of the consensus. The system, though, is not that big in it yet because it has been very, very volatile. Like again, it's one of these things where you can have a view on signal, but the reality is the price has basically been between 55 and 70 for a very long time, and it's been super noisy. It's been super noisy. Like every time it moves, there's no persistence in the move, really. It's so, kind of high amplitude, short wavelength reversion, and that's just not very good for trading trend, period. And do I think it could end? I do. But that's an opinion. We all have them. I sit in my armchair
Yeah.
and watch screens and read things and have opinions, but I guess we'll see. I
And just
guess we'll
as a
see.
reminder, and Charlie said this, but I just want to reiterate, CTA is entirely systematic. Neither Altus Partners nor Simplify are taking any discretion, which I think again is the beauty of this. Like sometimes we start to see things take off, and the trend following really needs to see those formalize, and also in relation to their volatility profile before we're going to enter those markets. So I think that's
Yeah,
helpful as well. And maybe just in the interest of time, and I actually flipped to the next slide because I think this is helpful as we start to talk about some of the increase in notional in our interest rate positions. And again, just kind of looking at some of the zigzag and commodity exposure in the far right-hand side of this chart, the black line, you'll see commodities
yeah,
kind of de-risked and then kind of increased significantly in the run-up of some of those prices. But interest rates have really slowly been kind of climbing the ladder really since like third quarter of last year. So,
yeah,
thoughts on positioning there and some of the drivers?
yeah. It's I guess it's a combination in as some of our viewers may recall, we recently added international, as in European bond futures, into the portfolio, and we've gotten bigger in this strategy in things like Italian BTPs and other non-US government debt toward the back end of the curve, like not the back, but like fives and tens. And the reason is that the carry signals are reasonably constructive. You've got some sovereign spread within the Eurozone complex, depending on the issuer, and also the curves are not as the front end rates aren't as high in Europe as they are in America. And so for those two reasons, the carry rate signals are more attractive. And then on top of that, there's been some mildly bullish trend signal as well. And so for those reasons, gotten pretty big. The position of BTPs is reasonably exposed right now. So the system likes non-US government bonds. And I think, again, wearing my discretionary hat, it's kind of interesting because European equities have been strong, and so our intermarket signals are not really saying, "Hey, go buy bonds." Like, it's not worried about a growth problem, and you want to buy duration as a growth hedge. It kind of feels more like a flow of funds type situation, where it's like their savings repatriating from the North America complex or out of the U.S. and into these other international capital pools. And I think it's just kind of a slow grind of international allocators basically repatriating savings in the context of being incrementally more concerned about the more aggressive U.S. stance. Now, we haven't heard a lot about Greenland lately, thankfully, and so maybe this will calm down a little bit. But I think there is an element of international capital allocators just sort of like repatriating, and it makes me bullish
Yeah.
European fixed income. It's a debt culture here in Europe. We're not as much of an equity culture as we are in America, but we love our fixed income and our bank yield instruments, and so I do expect a
As a
reasonably bullish.
reminder, Charlie is based in London, just for those that may not realize. When he's referencing
I'm a dual
we, and
citizen,
Charlie and I are both from Minnesota, so when you say we based on Europe, I feel like we're
right?
Minnesotan,
Which we are we
Charlie.
talking about? Well, I guess I'm a transatlanticist now.
Yeah.
So
But no, I,
very
I
good.
do think those comments are super helpful because a lot of times the bond positioning is a head scratcher for some people. And I think thinking
Yeah,
about the multiple indicators that we have and that carry profile has been such a big driver of a lot of the US rate positioning since inception, which has
yeah,
ultimately, and you'll see on this slide, this, th the overnight rates in the US, we've been predominantly short because of the comment Charlie mentioned on high rates at the front end of the curve in the US. And so the addition of these markets in Europe, I think, is wonderful just to have additional levers to pull for diversification. And they have different policies right now and different rates across the curve. And so there's opportunities for us to kind of extend and find kind of upside potential through some of the carry profiles in Europe.
totally. Cool.
So, with that being said, anything else, Charlie, that's top of mind? I think this episode is a little bit longer, but so much happened in January, and I wanted to make sure that we had an opportunity to chat about all of it.
Yeah, no, I think we covered it. It's a bumpy ride, but we built and implemented a system that's designed to do things that are different than everybody else, and we think that can add some value, and I guess we'll see.
Awesome. We will see for sure. This is just a quick visual of kind of where we're standing today. And this is the team. So, as you guys know, Charlie loves to get on client calls and talk through markets and such. So, please don't hesitate to reach out to us and we'll make sure to connect you with Charlie. But we're also here to support. So, really appreciate your guys' business and interest in learning more about CTA. And cheers to hopefully a less bumpy end of the first quarter here in 2026.